battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show. My name is Nick Stenger. We are Stenger Family Office. For the past 43 long years, the Stenger family has made it our mission to deliver both clarity and confidence to help secure your financial future. Oh, man, it is getting cold outside up here in Chicago. Producer Owen is so cold that he is, in fact, sporting the pea coat in the studio here. And it is cold, I will say. It's like 25 degrees. So if you are in Texas or Florida or Arizona, like many of our clients are, you are thinking, wow, I made it through the summer months, which were very tough this year. And you did make it all the way till the winter, which now you are laughing at us because it is very cold. So here we are. It's almost Christmas. We got a couple weeks away. We will be doing the big Christmas show. You don't want to miss that. And as long as we sustain this rally we've been having for 2024, the Christmas suit will make another appearance, which, you know, if you want to stay warm, that thing will do it. It is very warm in the Santa suit. And what else? Well, I hope you had a wonderful Thanksgiving. Hopefully you had a good time celebrating with your family and friends. And this week's episode 168, I just wanted to play off of Thanksgiving just for 2 seconds. And this week's title is Garbage In, Garbage Out, talking about you are what you eat, you are what you consume. At a certain point, you will become what you take in. And that's what Thanksgiving is all about. Thanksgiving is all about remembering the things that we're grateful for. And I think Christmas does that too. Christmas is just an extension of enjoying time with family and friends. And what do I always try to tell you on this show? I try to tell you the good reasons, the good things you should be optimistic about. Because if all you ever do is feed yourself the doom and gloom, and you have an appetite of CNBC or an appetite of Fox Business and all the horrible things that are happening in the world, and you've made a habit to go on CNN all the time, and that's where you get your news from. Well, what's going to happen to you eventually is you're going to become a pessimist. You're going to become a very, very sad person to be around. And the reason why is because the news is mostly negative. The news is not incentivized to tell us good things. They're not incentivized to tell us optimistic things and reasons why we should stay on our plan. And this isn't just CNN, it's Fox News too. It's all these news outlets that have learned over time that they get way more ad dollars coming in when they scare the pants off of us, quite frankly, and they are very good at it. And so anytime there's a crisis or anytime there's a black swan event that threatens our existence, or so they say, they basically want to tell you why you should buy gold and cash out your investment portfolio, run for the hills, and never return to the stock market again. And I'm here to tell you today, just like I've basically done on every episode since our inception, is just to say, stay on your plan and feed yourself with good news. Feed yourself with optimism. And so if you are consuming optimism and data and math and statistics, and you're really getting your hands on it, and you're not just reading headlines, and you're really understanding what's going on behind the scenes of the U.S. economy, well, you've got one choice, and that's to be bullish. And quite frankly, I don't think you can look at the data for the most part. There's a couple bad things out there, of course, just like any time in history, but you can't, in my opinion, look at all the data together and become bearish. I think today we've got a wonderful setup for 2025. I think we're going to see higher stock market levels in next year and the year after, and you should not be worried about the long-term trajectory of the stock market. Now, does that mean we're not going to have a correction? Of course not. We're going to have a correction. We're going to hand some back at some point. We will have a time where we see the market down 5% or 10% or 20%. But you trying to time that out, trying to figure out when to get in, when to get out, know when to hold them, know when to fold them, you're just not going to be able to do it. It's a losing strategy. It's called market timing. And you're thinking, Nick, I am the chosen one. I will be able to figure out when to get in and get out. I will be successful. I will prove you wrong and be a successful market timer. Well, sorry to tell you, but there's a whole graveyard full of people who have gone before you of unsuccessful market timers. I certainly can't do it. I don't claim to be a market timing expert. There's a lot of people on Wall Street that literally have entire algorithms built around trying to time the market, and they underperform the S&P 500 like every single year. So the fact that you think you're going to be able to do that, I think the odds are against you. I think the odds are more in your favor if you stay on a long-term goals-based plan. So stay optimistic, stay bullish. And I just want to recap again the rebalance, because a couple of you missed it. You're asking, Nick, what did you guys decide to do in the rebalance? One thing I will also say is if you're a Stenger Family Office client and you know your accounts at Schwab with us, that's the custodian that holds your assets, you already got an email a few weeks ago from Schwab letting you know we did a rebalance. There may be a couple more like that coming. We have a couple last minute things that we are wrapping up, a couple of tax loss harvesting items that we're finishing for 2024. So you may see some of those emails come in, but all that's telling you is that we rebalanced your account. What we did is we focused on 4 major areas, and Sam Hardy recapped this. If you are a client, you can request the video that he presented, his presentation from Investor Day, and that is available on YouTube. If you're a client only, you have to request it and let us know. But the 4 things are, number 1, U.S. equities. We are keeping you in U.S. equities. We're not doing international. Number 2 is large caps. I just think that large caps are going to be able to weather the storm of potential issues that we have with the debt markets coming up here, potentially with some of the resetting interest rates and all the rest of it. I think large caps are the place to be for now. Maybe there's a small cap or two along the way, but it's very tough. It's very tough to be a small cap stock picker. And I think large caps are going to protect you throughout entire cycles a lot better, quite frankly, especially if we ever have a recession, which I don't think we're going to in a recession, probably in 2025, maybe in 2026. None of us know. Again, this gets back to market timing. I don't think you can really time this out. But if we ever do go into a recession, you're going to want to be in large caps. They weather the storm better than small and mids. And then number 3, growth to value. This is the number of stocks we have in the portfolio, or if you have the ETF portfolios with us, how much is weighted towards growth stocks, companies that are growing revenue, growing profit, that you have to pay a little bit more for because they're growing faster, versus companies that are, we call them value stocks or more dividend-oriented stocks. Well, right now we've got the mix at 60-40, and I think that's the right mix. You don't want to be too overweight growth, because we've seen it happen ever since the Fed started raising interest rates in December of 2021, where the S&P peaked out at 4750. That was the all-time high at the time. Growth stocks actually suffered pretty substantial losses for 2022, and value stocks are what kept us going through, where you watched very carefully what you pay for a company. And value stocks are important, but the other thing to remember is you don't want to go too heavy on value stocks either, because if you do, what can happen is you can leave a lot of return on the table long term. You need to have growth, but you have to have a balance, and that's why we say 60-40. We've studied this now for many, many years, and I think statistically, that's the right mix to be. So, anyways, let's get into episode 168. You are what you eat. Garbage in, garbage out. If you are consuming garbage all the time, you will turn into you're going to have a trashy portfolio, because you're going to be in all cash. Maybe you're going to be in silver bars. Maybe you're going to have a bunker in the back of your yard, and you're going to fill it with canned foods. But if you are consuming positivity and good news and optimism, not blind optimism, but you're figuring out what's going on with the data and you're looking at the numbers, like I mentioned earlier, you're going to have a portfolio that's well balanced, but it's on a goals-based plan, not based on market timing or reaction-based fear. And I will go back to something that Michael Burry said. This was the guy who was featured in The Big Short. I believe it was the beginning of last year, and he came out with a tweet, and all he said in the tweet was "sell everything." 2 words: sell everything. Well, since Michael Burry came out with this tweet, the S&P 500 is up 57%. So thank goodness you didn't consume that garbage, that nonsense from Michael Burry. And look, Michael Burry was right. He's a really smart guy. He was right in 08 and 09. I don't know, maybe he'll be right down the road. But so far, if you had listened to him, you would have lost 57% of your return. I mean, how much in dollars does that translate into? And it's not just Michael Burry. It's a lot of these bears. It's a lot of these hedge fund guys who have said for years now that the S&P 500 is going to fall into an abyss, or that we're going to end up having a major depression. And typically, if you look at what they're selling, that's important. You got to figure out what these people are trying to sell you. If they're trying to sell you a bond portfolio, not really that surprising. Why? Because if we have a recession and yields go down, meaning the Fed cuts interest rates, well, that's good for long-term bonds. So a lot of the guys who are bearish and the gals who are bearish out there are saying that we're going to have a recession, hoping you buy their bond fund to so-called protect you in the downside. Well, a lot of the hedge fund guys say the same thing. They had one good year in 08 and 09. They got the Nobel Peace Prize, or they got the book signing tour and the Netflix special and the Big Short movie made about how great they are. Well, guess what? For the past 15 years now, they've gotten it wrong. And so if you get 1 out of 15 calls right, in most places in life, you should get fired. You should get canned. You should no longer have your job. For some reason, these hedge fund people and these Wall Street bearish strategists don't lose their job. They get promoted. They get better jobs. They get more money. People are like, here, take all my portfolio and please manage it, after literally leaving trillions of dollars of return. Maybe not trillions, but at least multi-billions of dollars of return on the table. I mean, it's absolutely amazing to me that people still listen to these doom and gloomers. Now, at some point, these doom and gloomers will be right. At some point, they will call it again. There will be something that none of us see coming. It won't be for any of the reasons they say. They're going to say that, oh, yeah, I called it. I was the person who saw it. Well, it's usually not the reason they say. It's some other reason. And remember, correlation doesn't equal causation all the time. And they're going to come out and say, oh, we called it. This was the year. And then they'll get the book signing tour, and then they'll get the speaking gigs and the Netflix special. And everybody's going to flock to them again and say, when's the next one? Please tell us. You're all knowing, Mr. Bear. Tell us the next time this is coming. And they'll go on CNBC and they'll pound the table for months and years and sometimes decades, and they'll be wrong. And so the reality is if you're going to be in the stock market and you think to yourself, Nick, why should I even be in the stock market? Maybe I should just be in bonds. Maybe I should put my money in a 4.5% or 5% treasury. Why should I be in the market? Well, the stock market's the only place you're going to be able to beat inflation. Why? Because companies have the propensity to beat inflation by raising their prices. So if their input costs go up, if it's a grocery store, for example, and all their items at the store cost more, or their labor costs more, or this or that costs more, the rent's higher, or the utilities are higher, what do? They raise their prices. And so companies over the long run beat inflation because they're the only asset class that can actually keep up with the rising cost of goods and services. So you ask yourself, Nick, why should I be in the equity market? Because if you're going to beat inflation for the next 10 years or 20 years or 30 years or even 40 years, some of you in your 40s, you got a long ways to go here to keep up with the rising cost of goods and services. Well, you better be in equities, because that's the place you're going to be able to keep up with it. So if you think to yourself, man, my Costco bill, I can't believe it. I went in there for blueberries the other day and somehow I walked out and it was like $400, like our family. You're thinking, well, I'll just buy some Costco stock. Or you go to McDonald's, you take your family of 4 to McDonald's, and you're like, whoa, I can't believe McDonald's is so expensive. Well, what do? You buy McDonald's stock. You go to the gas station, you're like, wow, I can't believe it's so much money to fill up my car with gas this week. Well, what do? You buy ExxonMobil stock. So that's how the stock market works. So you do have to be in the stock market. Now, putting that on the side for just a second, let's go back to the idea that you can possibly prepare for these corrections. And Peter Lynch, one of the most famous and most successful mutual fund managers of all time, has a great quote. And he says, more money has been lost preparing for corrections than in the actual corrections themselves. And so you say, okay, I know I got to be in the stock market. I know I have to allocate some dollars to an asset class that's going to beat inflation. Now, how do I actually put that together as a plan that's going to work over the long run? Well, like I've told you on this show for so many episodes now and pounded the table on, is you got to be on a goals-based plan. You can't try and time this thing. You can't try and figure out, I'll get in and then I'll get out and then I'll get back in, because you got to be right twice. You have to know when to get in and get out. And that's really tough. Not a lot of people can do that. And so what I would rather have you do is be on a goals-based plan. We sit down, we do a financial plan, or one of the advisors on our team, and you tell us a little bit about yourself. You tell us what you're trying to accomplish. You tell us when you want to retire and how much you're going to need for expenses. And then we set some of that money multiplied by a few years aside in short-term, high-quality fixed income, not in the bond market, but in high-quality short-term U.S. Treasuries, where you're going to get some sense of protection. You're going to get some ballast in case the market, or when the market goes down. And then everything else that you've got in your dividend paying stocks. Why? Because those dividend paying stocks are that inflation beating engine in the portfolio. And so the only time you change that, the only time, like some of you are asking me now, Nick, should we take a profit? Should we get out of the market? Should we change our strategy? And I'm going to come back at you with a question. I'm going to say, well, have your goals changed? Has your retirement timeline moved up, for example? Is there a big expense you think is coming next year that you weren't aware of before? That's what we want to find out. Has there been a change in your goals? Because if there hasn't been a change in your goals, my answer is going to be annoyingly the same every time. And I'm just going to say, if your goals haven't changed, I want you to keep staying on your plan. That's the biggest thing. That's the best thing you can do, especially when we get these doom and gloomers out there. Now, there's a few things that I would predict will happen in 2025. Number one, we're going to run up a little bit too much too fast. We're probably going to see earnings lag the price of the S&P. And simply put, all I mean by that is I think the S&P is going to go up a little bit too much too quickly, and eventually earnings will have to catch up to that. The earnings in the S&P will go up. I'm not bearish on earnings, but there's going to be a little catch-up period, and that will trigger a short-term correction. This is nothing new. Every year we have a correction. Sometimes we have 10%. Sometimes we have 20%. Usually kind of rare to have 20%, but sometimes we do. A lot of the times we have 5%. Like I said, 10% can be pretty common too. Usually once a year we have a 10% pullback. And what you have to be so careful of is if you're listening to that media doom and gloom, that narrative, that garbage, that nonsense, and you're getting all of your investment advice from Twitter, for example, well, just be careful, because when that correction happens, the doom and gloom narrative is going to say, these are the reasons why this time is different. You're going to hear that all the time. This time is different. And I've actually kept clippings of articles over the years where they literally publish that on CNBC or Fox Business, or they'll publish it on Yahoo Finance. And they'll say, well, we know corrections happen, but here's why this one's different. And if you take the bait on that, you will regret it for the rest of your life, in my opinion. So don't fall for it. Remember, I'm telling you now, it's coming. And what it's all going to come back to, what the S&P's level will eventually trade at, is going to be earnings times price. And if you've been following the show for any amount of time now, you are very sick of me saying this, but I keep trying to hammer this home. The S&P's level is not that hard to figure out. It's a simple math equation. Earnings, what do companies make in profit? Multiplied by what are those profits worth in the future? So why do the Mag 7, like Microsoft, Apple, Amazon, Netflix, Facebook, Google, why do they all trade at a premium? Why do they have such high price to earnings multiples compared to the rest of the stock market? We call it the Mag 7 versus the S&P 493, the other 493 stocks, not in the Mag 7. Why is there a difference in valuation? And there is. Well, one of the things that Wall Street's figured out, and the smart companies on Wall Street have figured out, is that reoccurring revenues are more valuable than transactional revenues. So if I sell you something one time, for example, if I'm Microsoft, I sell you a CD-ROM with new software and I sell you that once, that's not very valuable to the stock's price. But if I start selling you Microsoft 365 and now you're on a monthly reoccurring subscription, that's highly, highly valuable. It's very hard to replace that. It's very hard for a competitor to come in, and it's basically institutionalized. In fact, most things in life you cannot do without the help of Google. You cannot do without the help of Microsoft. You cannot do without the help of Apple. And because of that, not only do these companies have reoccurring revenues, they have massive, we call them moats, meaning they have a wide barrier to entry. And so all of these things add up to a higher valuation. Why is it that Walgreens is a complete dumpster fire right now? Well, because there's really not a barrier to entry. Amazon came in and ate their lunch. And number two, there's a lot of operating costs. And number three, there's really no reoccurring revenue. If you maybe decide, I ran out of, Gatorade and I got to go get one real quick. Well, yeah, okay, now you go to Walgreens. But most people plan ahead. Most people do their grocery shopping somewhere else. And so Walgreens, now they've lost their pharmacy business to a large degree. They've lost their competitive edge. They're having a lot of trouble. And so, again, why does a company like Walgreens trade at a 7 or 8 price to earnings ratio? And why does a company like Apple trade at 30 or 35? Well, there's a difference in business models. So we take all of the 500 companies in the S&P. We say earnings are probably going to be about $320 for 2026 because we're always looking forward. We're looking a year in advance. And then we're saying, what are those profits worth? Now, I'm not going to give you my outlook of what I think profits are worth yet for 2025. You're going to have to come back in a few weeks when we do the Christmas show. But I'll just give you a sneak peek preview, and that's to say that I think valuations are going to trend upwards. And so what happens is when interest rates eventually go down, when interest rates come down from their peak level like they have a little bit now, it reduces the borrowing cost for companies, number one. But number two, it increases the value of long-term assets. A stock's a long-term asset. And so I think actually what you're going to see with equities is you're going to see 320 in profit. And I think that 320 is going to be more valuable at the end of 2025 than it is today. Again, you got to come back in a few weeks and I'll give you my exact outlook for 2025. And we'll talk about that then. So all that to say, even if we have a short-term correction, even if we have a pullback in the meantime, don't let that narrative that comes out scare you. You just got to go back to that basic earnings times price equation, and that's what stocks are worth. So today, are stocks radically undervalued? No. Are they overvalued? No. I talked about that last week. I think they're fairly valued, and I think we've got some upside ahead of us. So go get the good news. Go get all the positive data, the statistics, all the reasons to stay bullish, and join us on the podcast every week. If you haven't subscribed yet, I would encourage you to subscribe. Get the show to your friends and family. And if you're watching on YouTube, hit subscribe. It helps us get it to more people. The other thing I'll mention, if you haven't subscribed yet, a reason you should is because if you thought about coming to some of our events, most importantly being Investor Day, which is going to be October next year. If you're subscribed, you're going to get invited to these events way faster than anybody else. Obviously, clients are our first priority. So if you're a client, you'll get invited right away. But number two, if you're not yet a client, you thought about coming to Investor Day in the past, you should be subscribed because you're going to get an invite before anybody else. And the reason that's important is because next year, we had about 100 people in person for Investor Day this year. Next year, we've got max capacity of 165. I think that's going to sell out really quickly. So subscribe to the show. Make sure you're looking for those updates, and we will keep you on your plan despite anything that we have thrown at us here, doom and gloom wise. And I would just encourage you, especially at this time of year, especially at Christmas time, just find a new hobby other than watching the news. Find a new hobby other than watching CNN and Fox Business and Fox News and all the nonsense that's out there, and maybe take a break from Twitter once in a while. And just enjoy this time with friends and family. Remember all the great stuff we have to be grateful for, thankful for. And so I would encourage you, stay on your plan and stay bullish. I think we're going to finish up 2024 very strong and have a wonderful 2025. Thanks for being here. We'll see you next week.